Are you a founder of a startup and need to brush up on your accounting terms so you know what you're looking at? Today, I'm going to go through the third video of accounting terms, the third and final. You can only get through so many finance and accounting terms. So I've already done two. The first one goes through the real basic finance and accounting terms. Then I'll go through ones that are a little bit more sophisticated. And today I just have 10 more that I wanted to take you through. Just in case you hear these terms and you don't quite know what they mean, obviously you can always Google them, but this video is quite quick and it just goes through high level some accounting terms that you'll find that you'll go through when you're speaking to investors, to your finance team, to bankers, and etc. Hi, my name's Alysha Randall from Fast Growth Consulting, and I help founders transform their finance function, ideally to minimize risk and maximize growth. So the first accounting term I want to go through was deferred revenue. So this is when money is received by the company for goods or services that hasn't been delivered or provided. So you may have heard of revenue recognition before, and this basically means the month or the time frame when you can recognize revenue. And generally, if you haven't completed the delivery of your product or service to a customer, then you have to defer this revenue and recognize it when you have. So a perfect example is if, say, for example, you have a subscription-based business and someone pays for a monthly subscription and they pay for it on the 15th of the month and the period of delivery is until the 15th of the following month. You would then recognize half of that revenue in the month that it's paid, and then half of that revenue would defer until the next month. If you're thinking about a product, you may have, say, sold a product on the last day of the month. However, it's still sitting in your warehouse at the end of that day and will be picked up, say, by couriers or Royal Mail the following day, which is the next month. Technically, that revenue cannot be recognized until the customer has received the goods, and therefore you would defer that revenue. The point of this is that there's a lot of things that you need to provide in order, or costs that you need to experience in order for that revenue to be delivered. And ideally, you want to recognize your revenue and expenses at the same time. So when is your obligation fulfilled? When have you basically earned that revenue? And that is when you need to recognize it. The second one is deferred expenses. So this is basically the same as deferred revenue, but the other way around. So they're costs that have been incurred, but not reported in the income statement from a later period. Generally in your balance sheet, it's not called deferred expenses, it's called prepayments. And really that's what it is, it's a prepayment. So you will find that with your accountants, they probably do have prepayments in quite regularly. A common one is rent. You may pay for, say, 3 months rent, and then you would prepay 2 of those months and unwind it as you are using that rent. Another one is if you have to pay for a service 12 months upfront. So whether that's in an insurance policy or some software, for example, you would defer the month that it's paid, you would defer, say, 11 months, and then every month your accountants would release 1/12 of that expense into your P&L. The next one is accrued expenses. So this, again, is the opposite. So it's expense that have been incurred but not yet paid for. So a perfect example generally is professional fees, accountants, lawyers, external accountants and lawyers or contractors. They may work for you in a given month, but you won't get their invoice until the following month, or sometimes with law firms or accounting firms, another month later. So ideally, you want to recognize those costs in the month that you have spent them, so to speak. So otherwise, if you don't, you will find that your P&L will be very lumpy. So instead of spreading the costs across the time that you incurred them, you are just recognizing them when you're paying for them. And then you don't have a good sense of what your profitability is in your business, because it's so up and down all the time. Next is accrued revenue. So this is revenue that has been earned, but you haven't yet received this in cash, or it's been recorded. So you may have, say, for example, agreed on a project, and it's going to take you 3 months to deliver this particular project, this service, and you're agreed that you wouldn't invoice for this service until the end of those 3 months. Because you're incurring costs and you're delivering for the first 2 months, it's best then to accrue that revenue at the same time that you're recognizing those expenses. So for example, if you have a service team or product team or a tech team, you have to pay for those salaries for the full 3 months. So therefore, the revenue you would also recognize over those first 3 months, regardless of when the invoice is paid, raised, and when the payment of that invoice is received. Number 5 is gross profit margin. So I did go through margins in quite a bit of detail when I explained the P&L, the profit and loss or income statement. So I'll leave a link for that above and below. But just to reiterate, a gross profit margin is basically the company's total sales revenue minus its cost of sales divided by the sales revenue, and it's expressed as a percentage. So if, say, for example, you get revenue for £100 and it costs you £35 to, say, have that product manufactured and ship it and package it and send it to the customer, then the gross profit on that sale would be 65, or 65% is the gross profit margin. Similarly is the contribution profit margin. So generally when I'm working with founders, we change the P&L structure so that it makes more commercial sense. And one of the subtotals I include is what I like to call is the contribution profit margin. This is very common. This isn't my idea. But essentially, with a lot of the costs outside cost of sales, they are quite variable. There's some that are very static. So, you know, the salaries of your leadership team, the rent that you have, they don't change really much. But sales and marketing costs, they are variable, even though they're not a cost of sale. So you don't have to incur them in order to provide the good or service to your customers. Essentially, you almost do, because it's a way of attracting new customers. So a contribution profit is then your sales minus your cost of sales, and then minus your sales and marketing costs. And then you have your contribution profit. If you divide that by a revenue, you have your contribution margin. Now, it's very common in early stage, particularly fast growth businesses, whereby there has been some fundraising. So you've got cash to spend on sales and marketing. You really understand your product market fit, and you want to invest in sales and marketing. It is very common at that early stage that the contribution profit margin is actually negative, but ideally you want that to go in the black as fast as possible. Next one is operating profit margin. So just like gross profit margin and contribution profit margin, this one is looking at the operating profits. So here is where you would take away all of your fixed costs from your contribution margin. And again, you would divide the net sales, you would divide the operating profit margin by the revenue. Generally, operating profit is EBITDA, which is earnings before interest, tax, depreciation, and amortization, or EBIT, which is earnings before interest and tax. So be mindful of when people are talking about operating profit, that's generally what they mean. So it doesn't take the interest and tax and FX, the kind of bits at the end, usually excludes those costs. I like to include amortization and depreciation, particularly if the company is capitalizing their tech costs, largely because I feel it doesn't have a true reflection on how much the business is spending. And I know with investors, they generally prefer you to expense your tech costs rather than capitalizing them. A lot of people capitalize them for R&D demonstration purposes, but I prefer to expense them, and I would still include depreciation and amortization within operating profit, generally because that is the cost of running business. It's not an unusual expense. Number 8 is working capital management. This is essentially looking at the company's short-term assets and liabilities and making sure that there's proper financial health and operational efficiency. Now, generally, if you have a finance leader, this is something that they will really spend quite a bit of time on. If you don't, then this is probably falls to you and operations. And what it is it's saying that you want the income that you are generating, the cash element, to come in as fast as possible, and obviously the outgoings to go as slowly as possible. So if it's the other way around, particularly at that early stage, you're really going to have cash flow problems. A perfect demonstration of that is if you're in a retail environment, you're spending a huge amount of inventory, you have to pay for that up front, and then it takes a long time to sell that inventory. You can see very quickly that you would have cash flow problems in this instance, and managing that is that working capital management process. Number 9 is liquidity ratio. So this is when you're measuring the company's ability to meet that short-term financial obligations. Generally, it's looking at the difference between your current liabilities and your current assets. So current liabilities will be the invoices that you owe that are, that are due within the next couple of months, as well as employment liabilities, such as social taxes, pensions, those kind of things, and then looking at how much cash the business has or accounts receivable, so invoices that are owed to you. So by looking at those two things, you can see quite quickly whether there's much liquidity in the business or whether you're going to have problems from a cash perspective. And then finally is capital gains. Most people understand this just from personal investing. The definition isn't any different with companies, but I thought I would include it just in case. So this is really the profit from the sale of assets or investments. So, if you buy a property, for example, for £150,000 and then you sell it for £200,000, the capital gains is that £50,000 difference. Okay, so that is all of the accounting terms that I wanted to go through. I thought it'd be good to do these early doors because then there is a glossary ready for you that want to learn more about understanding finances and accounting within your business. I'll leave some more resources down below. And if you are a founder within a startup or scale up and want to learn more about financing, whether it is managing your external bookkeepers or thinking about what a fractional CFO can do for you, or even if you want to upskill your internal finance team, this is exactly where we fit in. So if that sounds interesting to you, then please hit subscribe and I'll see you in the next video. Cheers.